Hello, everyone. Felipe here. Hope everyone had an awesome weekend. Happy Monday. So, as you know, I'm here to keep you up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for educational and entertainment purposes only. So, in this video, I'm going to basically be going over some financial market history. I'm really fascinated with this stuff because it kind of gives you an idea of what has occurred in the past. Sometimes it's very similar to what is going on in the present. Like Mark Twain said himself, history rhymes, right? So just to give you a bit of a comparison of what some of the information I'm going to be going over, I am going to be talking about the 2008 subprime mortgage crisis. And in comparison, to give you an idea, national debt in 2008 was $10 trillion. As of today, national debt is $32.6 trillion. Why do I bring this into light? Is basically because I speculate that the end of cycles in the market, at least, come at the end of credit cycles, credit expansion, the borrowing of money in cheap rates expands and creates this view of growing economy activity, but in reality, it is a lot of leverage. If you actually look at the numbers, the majority of GDP in the United States is government spending. Most of the time is using leverage, is using borrowed money. So in the 2007 subprime mortgage bubble, which in reality was created by the creation of CDOs, so collateralized debt obligations, which basically inflated the bubble in real estate at that period. It seems to always be the creation of a new kind of investment vehicle or product in the financial markets that ultimately leads to some sort of crisis. In this case, in 2007, it was basically the creation prior that I believe began in like the 1990s or something like that of collateralized debt obligations and other similar synthetic instruments, such as what are they called? A mortgage insurance, where other institutions were insuring other institutions from potential not being able to meet their liabilities. And then this just created like a domino effect, which was what led to the 2008 financial crisis, which was ultimately ignited by the catalyst that was the bankruptcy of the Lehman Brothers. So 2007 was 2007-08 crisis because other crises led to that end of cycle, which you can call a super bubble. It was basically inflated over a long period of time through the cause of other sequential crises that occurred prior that ultimately led to the 2008 situation, which basically the routine is always the same. Financial regulators step in, they save the system, they save whatever crisis is going on, only to further inflate the bubble into the super bubble by not fixing the actual problem. They simply always do the same thing. They stimulate, they merge away failing institutions into larger institutions, and in other words, kick the can down the road. It's like the nature of the financial markets. It seems that is basically the business cycle. So according to economists and market historians and all that, it is believed that markets should be left to their own devices. So markets should be free markets. They should not have regulator intervention. It should be left to supply and demand ultimately. However, it seems that regulators are necessary because they ultimately have saved every market from every crisis that has occurred throughout history. So markets being left to their own devices is known as market fundamentalism. And it's something that is very commonly talked about. So what makes a super bubble, like I was saying, a super bubble is basically the belief that markets should be left to their own devices. Markets should be free markets, without regulators intervening and without regulations being in place. But it seems that throughout history, every time regulators step in to save a crisis, and then they do allow markets to basically be free markets and left to the whims of supply and demand, it ultimately just ends up leading to another crisis. A notable example is the international banking crisis of 1982. I'll put in a quote here to kind of give you an idea of what happened in the summer of 1982. So in the summer of 1982, large American banks lost close to everything they ever had earned and more. And this was basically a lot of American banks were investing in emerging markets in Latin America, and everything just blew up, and literally all these banks lost more than they've made, that they had ever earned and more. If you want to learn more about this, there's a great book called The Dance of Millions, the Latin American Debt Crisis, that really goes into detail in this stuff. Following after that, shortly after, again, new creation of a new vehicle. At this time, it was portfolio insurance. This was during the 1980s. There was the creation of portfolio insurance, which basically insured investors' portfolios from worst case scenarios. This vehicle ultimately led to the October 1987 crash, known as Black Tuesday. Basically, portfolio insurance, if everyone has portfolio insurance, imagine when prices start to decline dramatically and this portfolio insurance has to be triggered. It caused exactly what occurred in 1987, October of 1987, which was a Tuesday known as Black Tuesday. And then why I'm pointing these out, because these are small crises that led up to the 2008 super bubble crisis, which again, they're crises that lead to bigger crises. So in the savings and loan crisis, basically that also afterwards that unfolded in various episodes from 1989 all the way up to 1994. Following that was the emerging market crisis, also known as the Asian financial crisis of 1997 and 1998. And then, of course, after that, the bursting of the internet bubble of 2000s, which is basically the dot-com bubble, right? Each time, every single time, each of these prior crises occurred, what did the financial authorities have to do? They had to basically intervene, merge away the failing institution. So the institution that got into trouble because they were taking unnecessary risk or doing things they should have not been doing, and ultimately led to the beginning of that crisis. So authorities stepped in, they merged that institution away. Well, most of the time, some of the times that an institution might have gone bankrupt, or they merged it away into a larger institution, such as we just saw recently with the First Republic Bank being acquired by JP Morgan. And then shortly after, they apply monetary and fiscal stimulus to protect the economy. basically kick the can down the road. It's basically what happens in every single crisis. It doesn't really change. And this here quote that I'm going to share with you beautifully explains this. Financial institutions have been merging into a smaller number of large banks. Almost all the banks are now interrelated. Everything's connected these days. The globe is connected. So the financial ecology is swelling into gigantic bureaucratic banks, often gastonized in their measurements. When one fails, they all fall. The increased concentration among banks seem to have the effect of making financial crises less likely, but when they happen, they are more global in scale and hit us very hard. Why? Because instead of having a lot of different institutions, now you merge away crisis and you have a smaller amount of interconnected institutions around the globe, basically. That's why these days when crises occur, they're typically global, not just for one country. Crises are now tend to be global because institutions around the world are interconnected more than ever. So basically, financial institutions or financial authorities step in, save the crisis, merge away the failing institutions, and stimulate the economy to stop the crisis that is ongoing at the time. However, what this does is it fuels prevailing trends of ever increasing credit and leverage, as long as basically they then allow markets to figure themselves out, be free markets, and the rules of supply and demand, and so forth. And it ultimately just leads to the next crisis, as we've seen through history and history over and over and over again, where eventually authorities have to step in again and save the system. And why I bring this into thought is because credit expansion and national debt is never been where it currently is. As I was showing saying for comparisons, in 2008, national debt was $10 trillion. In today's date, 2023, national debt is $32.6 trillion. So in 2008, which was the one can say the explosion of a super bubble, which was caused by many other bombs going off, which were other crises that had occurred in the past, such as the 1982 bank crisis, 1987 portfolio debacle, the 1998 Asian financial crisis, the 2000 .com bubble, and the savings and loans crisis of 1989. Seems that all of these led ultimately to what happened in 2008, because financial authorities step in, save the market, kick the can down the road. So the turning point basically for 2008 was the filing of bankruptcy of the Lehman Brothers, which basically precipitated the large-scale intervention of financial authorities. It took the FDIC, the Federal Reserve, and global financial authorities, everything they had to save the market and basically put it on life support during the 2008 subprime mortgage crisis. Shortly after the 2008 financial crisis, the economy gradually revived itself. I believe a year or so later, it all felt like a bad dream and basically business as usual, right? But in reality, in reality is that business cycles occur, booms and busts. It's just the natural nature of things based off of how the system currently functions. The system is actually broken and it needs to be fixed. If you think about it, the system is basically a credit expansion, crisis occurs, authorities step in, save the markets, kick the can down the road until eventually the big cycle comes to an end. The latest example would have been the 2008 financial crisis. Considering that as per comparison, the national debt in 2008 was a lot less than it is today. I'm curious eventually when the next super bubble is going to go off. On another note, basically, rates continue to go up. So this is on some market news stuff that I'm going to share with you guys. Rates continue to go up. The Federal Reserve last Wednesday hiked rates up another 2.5%, which is pretty high for history in terms of where it's been in the past, which this has basically caused the bond market to crash. Bond market has been crashing since they've begun hiking rates to where they are now. Why? Because basically bonds, for every 1% increase in the federal funds rate, for this example, bonds depreciate by 10%. That's huge. So we've seen a bond market crash. On another note, banks seem to still be struggling with deposit declines, and now it's affecting JP Morgan, Bank of America, Citigroup, and so forth. We've had the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. What happened to First Republic Bank and some of these other banks? They were acquired by larger institutions. So they were merged away by financial authorities into larger institutions. Kind of one of the quotes I was sharing with you guys earlier. Banks seem to still be failing. Why are banks still failing? Interest rates are increases in rates are bad for banks. Bad for banks. It's still causing issues in the financial system. So when does this stop? Most likely when rates go back down. But the tricky part is that inflation is a problem now. It wasn't in 2008, which allowed authorities to stimulate as much as they desired and ultimately save the system from the explosion of a super bubble. So that is the tricky situation now. If inflation is showing its ugly face, it puts authorities' backs on a wall in terms of what they can do. So in a way, I feel like they are preparing for what is coming by doing the damage now to fix the issues later. So yeah, that recently, I believe this happened last Friday, Heartland Tri-State Bank of Kansas failed on Friday. And what did they do? Federal Deposit Insurance Corporation taking control and basically merging it away with Dream First Bank. Beautiful example of what they always do. Failing institution gets merged into another institution, which then becomes a larger institution. So this becomes a bigger problem down the line. Doesn't change. It's a vicious cycle in the financial system. On another note, as I was using for comparisons, national debt in 2008 was $10 trillion. It's currently $32.6 trillion at a time where rates are going up. CPI report, inflation. Energy prices have gone down. I was expecting that. I was talking about that for a while. I believe the last CPI print was 3%. The tricky, it seems like, wow, inflation's coming down, but it's almost like an illusion unless you look at the actual data, right? Inflation seems to be sticky. What does that mean? Certain things are still going up in prices, which ultimately the idea is it would be better for these to be going down. Food prices are continuously increasing. All other items are increasing, and as well as all other items, less food and energy, which are considered one of the more volatile things when in the inflation is being tracked. So yeah, some stuff that I wanted to share with you guys to kind of give you an idea of what I'm thinking might potentially occur, and things that I find interesting that have occurred that are very similar to what are occurring now. For example, failing institutions being merged with larger institutions to kind of sweep the issues under the rug and forget about it, right? Until eventually that can be kicked anymore, and these smaller bombs explode the big bomb, which ultimately causes the super bubble to explode. So yeah, that is some market history I want to share with you guys and kind of paint a picture of the similarities, the eerie similarities of what still is going on, because in reality, the system never changes. It's the same system. And it's unfortunately a broken system that has not been fixed and needs to be fixed. So with that being said, if you like what I shared with you and you wish to hear more, please like and subscribe. I really appreciate you guys for joining me today. Thank you guys for your time, and talk to you guys soon. Have an awesome weekend.